Hello, everyone. It's Bob Freeman here to present you with free information, some of the best free information in the entire world, usually about the United States economy. But today we are going to be talking about the stock market, which is not necessarily the same thing as the economy. Uh, in case you haven't noticed, this is my first video without green hair, or without any hair at all, for the most part. I didn't really cut off my hair for any specific reason. I just wanted to change it up. I hope you like it. Just kidding. I really could care less. It's my head. I can do whatever the heck I want. So let's get on with it, shall we? What the heck is the stock market? First, we should probably ask ourselves, what the heck is a stock? So, when a company registers with the government to become a corporation, the company divides its ownership into what we call shares of stock. When a corporation initially files its articles of incorporation with the government, which is the document they have to fill out in order to become a corporation, they're required to state on that document a specific maximum number of shares that their company can be divided into, a certain amount of stock that they can issue. And each share of stock is equal. Every single stock represents an equal amount of company ownership, and no stock is larger than another. Each stock is an equal size. That's why I underlined that. The corporation itself owns a percentage of the total shares of stock, and the stock owned by the corporation that issues the stock, that stock is called treasury stock. The shares of stock that are not owned by the issuing corporation are referred to as outstanding shares. Now, how do investors buy and sell these outstanding shares of stock? These individual pieces of ownership of a corporation. How do investors buy and sell these shares? Most corporations begin private, generally meaning that the outstanding shares are only divided among people within the organization, such as employees, managers, executive officers like the CEO or the CFOs, or even groups of private investors. If a corporation goes public, this generally means that the corporation has allowed anyone in the public domain to buy and sell its outstanding shares. Outstanding shares that are available for the general public to buy and sell are listed by the corporation, almost always with the help of a major financial institution, like a investment bank, who then helps the company sell those shares in what we call the stock market. The largest stock markets in the United States and in the world are the New York Stock Exchange and the NASDAQ. These two stock markets contain stocks from over 6,000 different companies, and all of these companies combined are worth over 45 trillion US dollars. Now, who are the major participants in the stock market? This is an important question to ask yourself to really understand just generally how the stock market works. There's a lot of really specific things within the stock market and how it works, but these are just generally the most important, largest mechanisms in the stock market uh, that make up its just inner workings. So the major participants in the stock market are, of course, corporations that we had already talked about. They issue the shares into the stock market and also buy them back um, if they want to buy back the outstanding shares and have more treasury stock, or they can sell their treasury stock to the stock market. Corporations might also borrow against themselves to protect themselves against their company's risks. A example would be say a corn farmer expects for the price of corn to go down that year. All they can really do to protect themselves against that would be to borrow against the price of corn in the stock market. Um, it's a very general example, but just to give you an idea of why a corporation might participate in the stock market other than just buying and selling its own stock. An investment bank, their primary purpose is to service institutional investors who want to buy large amounts of shares and to help corporations get their stock out onto the stock market. So the investment bank will work with the corporation to get its shares initially onto the market, and they will sell their shares initially to retail brokerage firms, which we'll talk about later. The retail brokerage firms will sell those stocks to retail investors, which are people like you and me. The investment banks will also sell those initial shares to hedge funds, and they will also sell them to high net worth clients. But me and you don't interact with an investment bank unless we work there or are a high net worth individual. A retail brokerage firm is who people like you and me most likely interact with when we trade in the stock market. The retail brokerage firm sells retail investors, people like you and me, shares of stock in the stock market. And they charge a commission, and that's how they make money. The more people who trade in the stock market, like you and me, the more frequently they trade, and the more of them trade, the more money the retail brokerage firms make. And if the retail investors, people like you and me, lose money, the retail brokerage firms make money, because if you are buying shares for a high price and then selling them for a lower price with your broker, then they're making money and you're losing money. So retail brokerage firms make money by you losing money or by you trading frequently and them charging you a commission. High frequency trading machines are just super powerful computers that are owned by large institutions that trade the stock market using high level math that is too complicated for human beings to comprehend. They trade in really, really short time horizons. And I just thought it was worth mentioning that it's usually not worth trading really short time horizons because you cannot beat these high frequency trading machines. You're not going to be able to create one either. The odds are not in your favor to compete against these kinds of machines. Central banks and governments also sometimes participate in the market. A hedge fund, what their goal is to pretty much create a fund that provides a return that's separate from just the general stock market, just to create a specialized kind of fund for people to invest in. With usually the goal of having less risk than the general market, or providing more return than the general market. A wealth management or financial planning company, their goal is to help people with their personal finances, like with planning their retirement or perhaps saving for college, or maybe even possibly paying off debt, or saving for other various goals. Um, Retail investors, we had already gone over, people like you and me. Now, I put these participants on two sides because I just wanted to make it clear your goals are more aligned with these on the right hand side, just really just hedge funds and wealth management and financial planning companies. Like, really, you don't have to be worried about the things that corporations, investment banks, retail brokerage firms, high frequency trading machines, and banks and governments are worried about. Really, your goals align more with what a hedge fund's goals or a financial planning company or wealth management company's goals would be. Your goal is to, I guess, manage your own personal finances, as well as if you're going to participate in the stock market as a retail investor, to generate some sort of specialized return that either has less risk or more return than the general stock market. So, now that we got that out of the way, what causes the price of a stock to move upwards or downwards? A change in price of a stock is generally caused by the rules of supply and demand. For instance, if there are a lot of orders in the stock market to buy a stock and very few orders to sell the stock, buyers will have to compete with each other and pay higher prices until they can attract enough sellers. This causes the stock's price to increase. If there are a lot of orders in the stock market to sell a stock and very few orders to buy the stock, sellers will have to compete and sell for lower and lower prices until they can attract enough buyers. This will cause the stock's price to decrease because sellers will just have to continue to lower the price until there'll be people willing to buy it and fulfill their orders. Now this leads to the question, what causes stock market participants to increase or decrease their buying or selling of a stock? It's really up for debate. There's no definite answer, but most would agree that expectations is the primary factor. Typically, when expectations improve for a company, demand to buy its stock increases and demand to sell its stock decreases. Likewise, when expectations decline for a company, demand to buy its stock will likely decrease and demand to sell its stock will likely increase. Now, what causes market participants to change their expectations for a company? Because, as we can see, people's expectations for a company is what causes them to buy or sell. And buying or selling is what makes the price move upwards or downwards. So what causes participants to change their expectations for a company and decide to buy or sell the company and cause the stock price to move upwards or downwards? What causes market participants to change their expectations for a company? That's a big question. Well, expectations for a company can be put into three very, very broad groups. There's expectations for the economy. There's expectations for the sector of the economy which the company is in. And there's also just the expectations for the specific company. All of these relate to the company expectations, because if expectations are bad about the economy, it doesn't matter really unless the company's an extremely uncorrelated to the economy company, which some are, but most companies are very, very correlated to the economy. Expectations for the economy are correlated with expectations for the company, more likely than not. Some more than others. Expectations for the sector also very correlated with expectations for the company. So it's important to look at expectations for the economy, expectations for the sector, and then to look at expectations for the company. This is generally where all expectations for the company will come from. Over time, expectations, as they are beat, missed, or whenever new and relevant information is released, expectations will change. But consider any information that has already been released to the public to be already priced in to the current stock market prices. If it's already out, you're definitely not going to be the first person who has seen it and made a move in the stock market as a result. However, if your goal is to gain an informational advantage over the stock market's expectations, it is still extremely important to study the information that is already publicly available and already priced into the stock market. Why? To create your own expectations that you hope will be more correct than the stock market's. Think of price as a forward-looking expectations index. The price of a stock is usually an accurate way to measure the stock market's participants' expectations for that company for the next 1 to 18 months forward. The price of a sector's index is usually an accurate way to measure the stock market's participants' expectations for the sector of the economy for the next 1 to 18 months forward. Usually, the price of a major index, such as the S&P 500, is a very accurate measurement of the stock market's participants' expectations for the economy over the next 1 to 18 months forward. Now, notice I said usually for every single bullet point in this slide, because usually this is the case. 9 times out of 10, this is the case. However, 10% of the times it's not. Okay? Just keep that in mind. Usually. 9 times out of 10, but 10% of the time, market do whatever the heck market want to do. The price isn't always rational. So, with this in mind, thinking of the price chart as a forward-looking expectations index, a way to look at how the market expects the company to do over the next 1 to 18 months forward. Let's look at XYZ stock price. XYZ stock is one of my favorite companies. I hope that's not an actual company name because I do not advocate for anything named XYZ stock in real life. But so XYZ is a hypothetical stock. This is not a real stock. This is not financial advice. Do not go out and buy XYZ stock. XYZ stock price right now, if you look, wow, it's at the highest point it has ever been. XYZ stock is at an all-time high. What does this mean about the market's expectations for XYZ Corporation over the next 1 to 18 months? How does the market feel about XYZ Corporation's performance these next 1 to 18 months in the future? Well, the market thinks that XYZ stock is going to do better than it has ever done before over the next 1 to 18 months. Why? Because the market's willing to pay a higher price for XYZ stock than the market has ever been willing to pay for it ever before. It's a pretty good indicator that the market feels very, very good about XYZ stock if it is at an all-time high. So let's look at another example. XYZ stock. Say this just happened. You didn't even see anything in the news or in the reports. So XYZ stock does this, and say this very bottom level is zero. It's the price of zero, and right now it's trading 50 cents, and it's never traded that low before. XYZ stock has fallen from $100 a share to 50 cents a share. A lot of people would think, well, holy crap, I like XYZ Corp, and that's so cheap, 50 cents. It used to be $100. Maybe it'll go to $100 again. That's so cheap for 50 cents. But if the market discounted a stock's price from $100 all the way down to 50 cents over any period of time, honestly, it's likely the market does not feel good. And say it's discounted to 50 cents, and this 50-cent level is the absolute lowest price this company has ever been at before. The market is telling you that it's received some sort of information about XYZ Corporation that makes them feel not good about it over the next 1 to 18 months. Actually, market likely sees something that makes them believe that it's likely to go bankrupt. It sees a price movement from $100 to 50 cents, from an all-time high to an all-time low. It's likely the market assumes it's going to go bankrupt. But what the heck is the stock market at the end of all of this? I'm going to give you a quick summary, just so you know what is important, because I know I like to ramble a little bit. Ownership of a corporation is divided into shares of stock. Corporations may sell their treasury stock in order to raise money. Shares that are not owned by the corporation are called outstanding shares. If a company is public, then market participants are allowed to buy and sell that company's outstanding shares to the public via the stock market. There are many participants in the stock market. Demand to buy a stock and supply of shares of stock for sale is generally what causes stocks to change in price. Expectations for the sector, company, and economy 1 to 18 months forward are generally what cause market participants to buy or sell a stock. So look at price as a forward-looking expectations index because it factors in all of the market's participants' expectations for the next 1 to 18 months forward. That's all the information that I have for you all tonight. Wow, it's 11:11 right now. Make a wish. I hope you all have a great night, and the next video will actually be much longer and in much more detail, and it will be about what's happened in the economy for these first 7 months of the year 2021. I will be including information about Q1, Q2, and the first month of Q3, which was July. And I will be including information about manufacturing in the United States, services companies in the United States, as well as 18 different sectors in manufacturing and 18 different sectors in services. So look forward to that video because it's going to be extremely good if you pay attention. And I hope that you all have a good rest of your night for the second time or the third time. I think that's the second or third time I've said that. Peace out.